what does a balance sheet do? A balance sheet shows us what we own, assets, and it shows us what we owe, liabilities. It identifies what we own free and clear, with no obligation, and what items that we are still making payments on. So example, in a personal balance sheet, this might include our car, our house, our personal belongings, and our savings accounts. Even if the home, for instance, still has a mortgage balance, then it is still shown as an asset because it does have value in it and it is something we own. But what the balance will be is on the other side of the equation, and that is the balance that we still owe on that mortgage will show on the liabilities side. It would also list any monthly payments due on any of these liabilities. Those are called current liabilities. And we also have current assets. We'll look more at those in just a moment. The difference between our assets and our liabilities is our financial worth, also known as owner's equity, retained earnings, equity in the business. Let's talk a little more about what a balance sheet does, and then we'll pause for a moment of questions and make sure we're all on the same page. It is the same as your business's balance sheet. The point there is that, like a personal balance sheet, it will list our assets and our liabilities, and the difference being equity. For instance, a restaurant's asset list, and we do have a restaurant owner or two out there, would include things like equipment, supplies, furniture, utensils, aprons, dishes, etc. The belongings, the assets, the resources that we need to run that business. A restaurant's liabilities, for instance, would include things like money that's owed to suppliers, payroll, and any balance that might be due on a credit card or a loan, money due to someone or something else. We also have a couple contractors out there, and their balance sheet would include things like trucks, trailers, any tools that the business owns. Again, assets, resources that are used to do business. Similarly, the contractor's liabilities would include a list of any money that's owed for things like materials, payroll, credit cards, so on and so forth. Let's take a look at what a balance sheet looks like. And here, pause for a moment and open it up. You can dive in with a question or comment or use that chat box. But let me just take a pulse of the group. Do we have any questions or additions? We just defined a balance sheet, looked at the equation, and we talked about what a balance sheet shows us. Okay, let's proceed. There's a couple other exercises. We'll have much opportunity to interact. So what does a balance sheet look like? And let's break down the terms a bit so that we understand the difference between current and long-term as it relates to a balance sheet. As we saw earlier, a balance sheet shows three things. It shows assets, total assets. It shows total liabilities, and it also shows our total equity in the business. What is always true is that the asset side of the balance sheet will always equal, and that's on the left side, will always equal the right side of the balance sheet, and that is where we have the sum of the total liabilities and the equity. So as there is a change on the asset side, there will be a change somehow on the liabilities or the equity side, because it's the right side of the balance sheet that makes the left side possible. Current assets is a term we'll want to review, and that is describing any asset that will be used or consumed within 1 year, literally 12 months. So things like cash, generally accounts receivable, will also often have accrued receivables on here, that which we expect in. Current liabilities are those that will be due or repaid within 1 year. So things like credit cards. We try not to carry a large credit card balance for very long. We know that that is one of the, if not the most expensive ways to finance a business. So we work to make that be paid off within 1 year or as soon as possible, therefore making a credit card considered a current liability. So what we do with these balance sheets, this one is as of first quarter, March 31st, is we compare balance sheet from the preceding years with the balance sheet of the current year. So for instance, in my business, very soon, we will have year-end 2021 financial statements available, and we will compare those to 2020, and frankly, we'll look back at 2019 as well. It is not as much the numbers which tell us the story of what the business is doing or how it's doing, but it's the trend in the numbers. So if I compare 2021 to the previous year, how does it look? Did assets go up? Did liabilities go up or down? And how are those two related to help decide what happened in my business and what is the trend? Again, balance sheets show a picture as a snapshot in time. So this one shows us as of March 31st of that year, this is what things look like. That's why we compare year end to year end. Any questions as we look at a balance sheet? Questions or additions to the conversation? You can tell that I intentionally made this simple using nice round numbers. That's for illustration purposes. Everyone's balance sheet, of course, is going to look differently, have more items, and have different numbers. Okay, we do have a question. Are you looking for the total assets to increase year over year? Outstanding question. Can you send a copy of this slideshow? We can make this copy available. I will also share that it is being recorded and it is available on the Small Business Development Center's website page through YouTube. So back to that question, are you looking for total assets to increase year over year? Great question. I'm going to give you a great answer. It depends. It truly depends on what kind of business we're in, what stage of business we are in, and where we are in the phase of a business. For instance, a business like Eastern Oregon Business Source that's been around for over a decade, we really don't have a need for our assets to increase year over year. Instead, we look to diversify sales and increase income and those sorts of things. You may be a business owner that maybe is just starting out, or you've only been in business a short time, and it would be understood that over time you would accumulate assets, therefore looking for your total assets to increase year over year. So it just depends where you are in business, what stage, what phase, as well as what kind of business you're in. Great question.
For helpful places.
Thank you for watching our video. If you would like to speak with a business advisor at no cost to you, please feel free to reach out. We're the Small Business Development Center at Blue Mountain Community College. Please attend one of our workshops, either virtually or in person, or just give us a call. Thank you.